Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Monday, January 17th, 2022, and I'm pre-recording this Trading Places Live for Tuesday, January 18th. Futures currently are mixed. Looks like both the Dow Jones and S&P 500 futures are up slightly. Dow futures up 38 points, or roughly 0.1%. S&P 500 futures up 2 points, or 0.04%. So just slightly higher. NAS futures, meanwhile, are actually down about 0.1%, down about 15 points. So we'll see if we open up like that in the morning, but at least the early numbers show that maybe we'll have a mixed open in the morning. Before we get started today, I'm going to go through the agenda. So we're going to start off with the daily market recap. Then we'll get into talking technically, sentiment issues, blog highlights, earnings spotlight, and then we'll wrap up with the 3 you must see. Before we get into any of that, let me take you over to earningsbeats.com, where if you go over, you can sign up for our free newsletter. So again, go to earningsbeats.com. You can scroll down right here on the left-hand side. You can see the free Earnings Beats Digest sign up area. Name, email address is all it takes. You can hit that subscribe button. There's no credit card required, completely free. This is a newsletter I publish 3 times a week, Mondays, Wednesdays, and Friday mornings. And normally we get it out by about 8:30 in the morning, normally Eastern time, so about an hour before the market opens. It's a very quick read, typically 2 paragraphs in a chart, but it'll give you some pretty good information as far as how we look at the market. So just, I think you'll begin to understand a little bit more about us at earningsbeats.com by following us with the Earnings Beats Digest newsletter. Also, we do have a lot of free events. We had one of those earlier today on Monday while the market was closed. We had a sneak preview of our Q1 earnings. We do one of those each quarter, and anyone who's on our free newsletter is eligible for any of those free webinars that we do. We always send out room instructions and a link. So that's another great reason to become part of this newsletter, to attend, I think, some high quality educational events. All right, let's move on and talk a little bit about what happened on Friday. The Dow Jones Industrial Average finished down 202 points. The S&P 500 was up 4, and the NASDAQ was up 87. So we've had this bifurcated market where you can see over the past 6 to 8 weeks, the Dow Jones going higher, the S&P 500 going higher, higher highs, higher lows. The NASDAQ, on the other hand, has been going the opposite direction, lower highs and lower lows. So we've been seeing this bifurcation in the market. We saw it again on Friday, but it was reversed. We saw the NASDAQ actually performing better than the other two. Mid caps, small caps continuing to sideways consolidate. They were mixed on Friday as well, with the mid caps down about 1/3%, small caps up nearly 0.5%. As far as the sectors go, another big day for energy. Energy's been very strong, definitely the best sector of late. Huge breakout above that 58, 59 area on the XLE, and we've just continued pushing higher, up another 2.3% on Friday. Technology also up pretty solid, between 8 and 0.9%, but the look here is much different. We've actually broken down below our moving averages, went back up and failed at the moving averages, now rolling back over again. This is not a good look, and another new low on the XLK would likely result in further decline in prices there. Communication services continuing its downtrend, although it did rally a bit on Friday, up nearly 0.5%, but I think that overall downtrend clearly established at this point. Real estate is still in an uptrend, but in January, it's been a pretty rough period so far. First half of January not been very kind. Started the year up near 52. We've dropped all the way back down. We were below 48 on Friday, but we did manage to come back up a little bit above that at the close. I would be looking for a reversal somewhere around this level in real estate. This is about where we broke out from, this 48, 49 area. Back down testing that. This is where I would look for the bulls to step back up again. Real estate did finish down more than 1% on Friday. Financials also down more than 1%. Those were your two biggest losers and laggards on Friday. The 10-year Treasury yield, as far as economic news on Tuesday. We're going to get the January Empire State Manufacturing Index. Expectation there is 26.0. December was 31.9. So we're looking for a decline there. January Housing Market Index expected to be unchanged from the December level of 84. We'll see both of those again coming out in the morning. As far as the 10-year Treasury yield goes, we've broken out, we've pulled back, tested the area of the breakout. We remain above that rising 20-day, which is above the 50-day. Currently, I think you'd have to say we are in an uptrend. So I would be looking for higher yields in the near term. That probably will not bode well for growth stocks, and likely will bode much better for value stocks. And that's what we've been seeing throughout this uptrend, is money rotating toward value. All right, let's move on to talking technically. I want to just show you these absolute charts on the three growth indexes that I like to follow. First, here's the large cap. Now, the large cap, you can see clearly has been an uptrend for a while. This is the one area of growth that has performed well, and it houses the big names like Apple and Microsoft and Google and Tesla and those names. And so as long as this remains in an uptrend, then I think the S&P 500 can continue to hold its own without too much of a decline. However, I don't like the chart here, and I don't like this false breakout right here, the reversal, taking out this double bottom. And then when we came back up, it looked like, okay, maybe it was a false breakdown, but then we got up to the 20-day and we failed. And now it's just giving this look now of a downtrending area of the market. And if the large cap growth names continue trending lower, I don't think the S&P 500 hangs in there. I believe we are going to go lower. So I would be very careful. It's going to be telling to see what happens with these earnings reports. Earnings are going to have to be stellar. I think in some areas like energy, maybe in other areas like consumer staples, I could see some pretty good reports coming in. I just don't know about these growth stocks. I think there was just too much. I think the value was taking into account too much growth, very little bad news or negative news. And I think a lot of these growth stocks, especially the large cap names, are priced for perfection going into earnings. And the bar's set high. We'll see what happens as these names begin to report their results over the next couple of weeks. The mid cap growth, taking a look here, there was an uptrend in play, but I believe with this breakdown here, we were unable to get back up to clear the prior high from back in November, and instead rolled over and printed lows that we have not seen since back in June. So these mid-cap growth names really struggling. I would like to say everything's going to turn right back around to the upside, but I really don't believe that's the case. I think we could move back to the 20-day EMA. That's certainly possible at any point. I would be very careful, though. If we get there, I'd be looking for a reversal back to the downside. Small cap growth, very similar. You know, we to mid caps, that is. We had an uptrend in play, really kind of broke down at the end of November, early December. You can see we put in slightly lower lows here, did it again in mid-December, and now in January, really falling apart below the 20, which is below the 50. That PPO, which is showing really bearish short-term momentum, continues to accelerate to the downside. I just don't see anything other than perhaps a bounce in the near term to the upside. I do believe that the picture here that I'm seeing is that we're probably going to go down and at least test the March low that we saw 10 months ago. So we'll see from there, but I just a little skeptical here. You know, I've turned bearish. I've been writing about it, been talking about it, and I'll tell you some more in just a couple of minutes. We'll go over some other areas, but yeah, we got some issues that we still have to deal with. The S&P 500, one of the charts that really has me concerned is that as we continue to push higher and higher, and we've been in this uptrend for a long time, it just seems like it's getting a little bit ragged and a little bit tired. The momentum continues to fall. The PPO continues to go down, even though prices have been going up month after month after month. It just looks like we need time to pause, to sell off, to reset. This weekly PPO needs to get back down to the 0 line, maybe even dip below it. I don't think we'll see anything. I definitely don't see a big decline like we saw for the pandemic back in February, March, April 2020. I don't even see I don't know if we'll get as far down as 2018 or not. That remains to be seen. I wouldn't be shocked if we have a 3-month decline that's close to 20%. I'd be looking for a minimum of 10% off that recent high back to about maybe 43, 4,400. If that breaks the 50-day and the prior lows we saw in September, October, then I think we could start to see something more like what we had at the end of 2018. So look to see if we have an A drop, a B recovery, and then if we go down and we break that first low, that A low, that's when I think selling could accelerate into a C leg to the downside. All right, let's see what else we have here. How about let's move on to sentiment issues, because I do think this is one of the biggest issues that we have right now in 2022. I just think the market's gone so far without really much of a pullback that it's created this little sentiment bubble, if you will. If you look at the CPCE, the $ CPCE, this is the CBOE options equity put call ratio. This is a 253-day moving average, this blue line that you're looking at. So right there, that moving average, 253. The way you set this chart up is you go down here and you put in an invisible chart, your type. Usually I have candlesticks or a solid line. Here, we're going with invisible. So in other words, all the data is invisible. You can't see the data. What you are seeing on this top panel right here is the overlay, which when you go down here under overlays, simple moving average, 253 days. It's a daily chart, 253 periods. So 253 days. That's a year, roughly. So when you look at this, the market, it has its ebbs and flows. It goes up, and then folks get very complacent, thinking it can't do anything but go up. That's not good for the market. Then it goes down, and then everybody gets pessimistic. Market thinks we'll never come back. That's bullish for the market. That's when, all the sellers are taken out of the market, and then you get buyers coming in, and all of a sudden the demand outstrips supply, and you start moving back to the upside. Well, I want you to look at this chart. This was one of the charts I went over at Market Vision 2022 recently. If you look at this chart, when we bottom in this, annual average on the CPCE, this is effectively telling us as we're going lower, this means that the number of puts being traded versus calls is going down. So if you're trading fewer puts, that means that the market is getting very complacent, a lot more calls than puts. So when a lot more calls and puts are being traded, then you have to start to think anyway, hey, maybe I need to be a little cautious here. Well, if you look at the S&P 500, when we were going down, we had a nice advance, 19.7%, almost 20% on the S&P 500. But once this number turned and started moving higher, you can see through as the pessimism built off of this prior low, you can see that over the next 2 to 3 years, that was the secular bear market, the financial disaster that we had back in 2008, 2009. But that, as we were ramping up the fear, the market was going down. And then we got to a point where the fear topped, and then the fear started coming down. And during this period, while the fear is coming down, you can see the market rises 101% in 2 years while this is coming down. Then we get too low again, too complacent. We start moving higher. We start seeing more puts being bought. Market gets more fearful. We go nowhere during that period. Then we rinse and repeat again. We start coming down. Market's up 56% during this decline. Then we go up. Market goes nowhere. We come back down. Market up 47%. A lot of choppiness 2019, 2020 between trade war, the pandemic. And you can see the market was just all over the place. But once we had this move to the downside, and we went way low, this is the lowest number you can see this century. So we got incredibly complacent. Nobody believes the market can go down right now. And we rose 112.4% in less than 2 years. Now, this moving average is at the highest level we have seen since back in probably April of 2021. So it's getting close to a year, about 9 months. We're at a 9-month high. Well, if this is just starting to the upside, we don't have a whole lot more room to go to the downside, by the way. This is historic bullishness and complacency. So I think as we're moving back up and the market's beginning to grow more complacent, or excuse me, more fearful, and comes out of all of this complacency, I think we have room to drop on the S&P 500. And when you look at the market, I mean, we've been going straight up. I mean, would it really be horrible, even if we were to fall all the way back to 4,000? I would still tell everyone we're in a secular bull market. I believe whatever happens in 2022, even if it's to the downside, is all occurring within a secular bull market. So just because I think short term we could have issues doesn't mean that I'm a bear. I'm still very bullish, but I'm a realist. And again, we've run up quite a bit, and I think we could be in for some selling. Now, if you look at the S&P 500 here versus the CPCE, this is looking at it on a weekly basis. Anytime that we just temporarily set this 5-week moving average down below, say 0.55 right here, anytime we've gotten down there, generally the market has struggled. I mean, look at where all these come in at, these red arrows. They're all coming in, you know, where we've had these complacent readings. Look at what has happened over the last year and a half. I mean, the market couldn't get much more complacent. Everybody thinks the market has got to keep going up, or at least options traders do. And that is a problem. So until we get back to more normal, I mean, we don't usually see major bottoms form until the pessimism spikes up to where we have a 5-week average of over 0.80 puts versus calls. Almost, you know, getting close to 1-to-1. Right now, we're down close to about 1-to-2. So it's really, you know, we got a lot of pessimism that we have to get through. The market is not prepared for weakness, is kind of the way I look at it. And this next chart I show you will kind of confirm that as well. This is volatility. So these sentiment issues, I think, are real. When you see the market going up and the volatility index is going up with it, that's what happened in 2007. You know, as we were going up, we were steadily going down in the VIX. Market was going up. And when we got to the 2007 peak, you can see the VIX had surged quite a bit off of that bottom. And the market was, and what I always say is when the VIX is rising with the market, it's telling us we're getting fearful and we're probably not going to handle bad news very well. That's what happened right before this big drop. If you look back to 2015, 2016, when we went through all of that sideways action there, a lot of that occurred after the S&P went up for a year or more, while the VIX never went to a new low. So once again, now, I mean, you could look at all these highs along here. Each of them was seeing higher VIX readings, but ultimately we had to pay a price for that. We kept going higher and higher, and then we went sideways for a period of time before we resumed the bull market. Now, look at what we've been going through for the last 3 or 4 years. This high, this high, this high, and current high, every one of them have occurred with higher VIX readings. The market is getting more nervous with each higher high. That is not good. And I think it's going to result probably in something like what we saw in 2015, 2016. That would be my guess. Might just be one move down and then right back up again. But that one move down could be 10, maybe even 20%. I'm not saying that it's going to do that. I'm saying that I believe the odds are much higher. So I think you've got to do whatever you feel comfortable in terms of protecting yourself in the event that this does happen and we do have this pullback. So it could just be protective puts. You could sell calls, you know, have covered call strategy where you're selling calls against your position just to help protect a little bit to the downside. That doesn't fully protect you, but it'll protect you a little bit in the event that we sell, you know, go through a period of selling. All right. Let's see what else we have here. How about we move on to the blog article? So let's talk about blog highlights. This is the blog article I wrote on Monday, talking about the two most important ratios before earnings come out. And this is a big part of what we do at Earnings Beats. So on Friday, the banks started, they kicked off earnings season. We had JP Morgan, we had Wells Fargo, and we had Citigroup, all reported on Friday. And I think this is a really good lesson to go through. When you look at the results that came in, Wells Fargo beat on their revenues. JP Morgan missed on its revenues. Citigroup missed on its revenues. When we look at the earnings per share, all three beat, but Wells Fargo beat their estimate by 27%, JP Morgan by 12%, Citigroup by 5%. I would say based on these results, Wells Fargo by far had the best results. So we look at the reaction. So prior to earnings, so from the low on the bank index from back on December 20th to the close on the bank index the day before earnings came out. So this would have been the close as of last Thursday. So from December 20th to the close last Thursday, January 13th, the bank index went up 14.52%. So if we look at the performance over that exact same period, here's the bank index, and here are the other three stocks leading up to earnings. Wells Fargo outperformed by 5 percentage points. Citigroup outperformed by 1.8 percentage points, and JP Morgan underperformed by about 4.5 percentage points. So I would say heading into earnings, Wall Street was repositioning, putting more money into Wells Fargo, less money into JP Morgan. Citigroup a little bit more along, kind of in the middle. Now, with the earnings report that came out on Friday, Wells Fargo went up 3.68%, and both Citigroup and JP Morgan both lost ground, especially JP Morgan, dropping 6%. Bank index lost 1.5%. So it's clear to me that Wells Fargo is being anointed as one of the leaders in this space and on Wall Street. And when you look at this chart, I think it becomes very, very clear. Bank index has been rising on a relative basis here over the past few weeks. Wells Fargo versus the bank index has been rising for a year. Citigroup versus the bank index has been going down mostly for a year. Same with JP Morgan. JP Morgan has really just collapsed here in January of 2022. So there's no doubt in my mind money is rotating towards towards Wells Fargo. I think Wells Fargo among those three stocks is the stock to own and has been for a year or more. And I've been talking about Wells Fargo, included it in some of our portfolios here over the past couple of quarters. All right, let's keep moving on here. So kind of in this theme, we had an event earlier today, Monday the 17th, and it was our Q1 earnings sneak preview. And what I did is I unveiled a new chart list that we're putting together for our members. This one is actually for our annual members because it takes such a long time to put together. But at the beginning of each week, we're going to be sending this out. And essentially what it is it's every upcoming earnings report this week that has a market cap of at least 1 billion, is liquid, so trades at least a couple 100,000 shares a day or more. And I've included these price relative charts that you can see. It's like, for instance, Schwab reports Tuesday morning. Well, this chart is Schwab relative to its investment group, which is investment services. And you can see Schwab is going straight up versus its peers. It's really a strong performer within investment services. And investment services relative to the S&P 500 is not bad. Just last week, we were actually not too far from a 52-week high. So overall, I think we're doing okay in this group. And then Schwab is a clear leader. So I believe we'll see a great report out of Schwab. Now, the thing that's beautiful about this chart list is we can pull this up and view all mode, and then we go to a summary. And before the earnings come out on all these companies, we can go in here and see how companies have performed relative to their peers and compare them to all the other stocks relative to their peers in terms of this percentage change. So versus its peers, Schwab has outperformed by 15.7%. And of all the companies reporting this week on this list, and there's 67 of them, Schwab has the strongest relative strength over the past month. And I think that very well could be an indication that we should expect a very strong report out of Schwab. So if you go down, you'll see they're all ranked in order. Right now, most of the companies reporting this week are banks, and I audited banks. I mean, banks have to have their accounting house in order very quickly after the end of the quarter, because they do a lot of reporting with the Federal Reserve. So as a result of having to report with the Federal Reserve, they normally have their books closed very, very early. And that's why you see mostly banks reporting right now. Next week, this will all change. Week after that, I mean, we'll have just a smorgasbord of earnings reports coming out. All right. So let's talk about the 3 you must see. Let's wrap this thing up. And I'm going to bring up 3 charts on the 3 you must see that were all on this upcoming earnings relative strength chart list. That this chart list, by the way, is going to be available every week for our annual members at earningsbeats.com. So all of our members that are annual members, because we're going to be putting many, many, many hours every week into this chart list to have this available, downloaded right into your account at StockCharts. If you're a StockCharts Extra or Pro member, you can download it right in. So let's take a look at the 3 that I believe are all going to report strong results coming up this week. And I think they all report on Tuesday. The first one is Schwab. I just talked about. Now here's an actual absolute price chart. I showed you the relative price chart. And here you can see down here Schwab relative to the investment services. So that's what I was showing you before. Here's their actual chart, though. Not only have they broken out and trending up above the 20-day moving average, look at that AD line showing accumulation. I believe the stock's being heavily accumulated. Look at the volume coming in on this move to the upside. I believe institutions are pouring into Schwab right now. So this is one of my favorite stocks as we go into earnings this week. The next one I wanted to mention was JB Hunt. This is transport, a trucker. Stock broke out back in October with nice volumes, continue to perform pretty well. You can see over the last month, AD lines really moving up. We just broke out on a relative basis versus the trucking group. I think this is another one that will come out with strong results. They'll report Tuesday after the bell. And then the last one I have is CNXC. This is Concentrix Corp. This is actually in the software space. And software has been going down, so is the stock. But on a relative basis, this stock has actually been outperforming its group. The volume has been pretty good on these up days, these kick saves. And the AD line just went to a new 52-week high. So I think CNXC is a stock that we ought to at least be thinking about as maybe an outperformer in the software space as we go forward. But earnings tomorrow night will dictate some of that. All right, that's it for me. I'm going to wrap up. I do want to invite everyone to come over and check us out at earningsbeats.com. We have a 30-day free trial. We're going to have another earnings, our quarterly earnings, Q1 earnings webinar next week that's going to talk about all the future companies that'll be reporting, not just this week's. So if you want to be part of that, a 30-day trial will get you there. We'd love to have you. Listen, have a great day. I'll be back on Wednesday morning over at Earnings Beats for your next Trading Places Live. Take care, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.